I want you to think back to late 1999. The markets have been on a tear. It's the tech bubble, and life is good. Britney Spears, Ricky Martin, and Cher are topping the charts, and it seems like the party is never going to end, until it did. So today I'm going to challenge conventional market wisdom. Most investment managers will tell you, 1, that markets tend to go up over the long term, and 2, you should sit tight and not do anything through bear markets because eventually you will recover those bear market losses and go on to see greener pastures and bluer skies. Whereas I agree with the first assertion that markets do rise over the long term and that bear market losses do get recovered and you do go on to erase those losses and make new gains, that does not mean, and I do not agree with the second assertion, that you should just sit tight and be inert and ride bear markets all the way to the bottom. In this example, I want to point out how one large loss can wipe out several good years. So in this case, I have a 5-year example based on $1 million investment. You have 4 good years, a bull market of 4 years, followed by a bear market in the 5th year. So looking at the high volatility portfolio, in the 4 good years, the first 4 years, it gains 15% each year. So pretty good, 15% each year. You know, the sum of returns is 60%. In the bear market year, in year 5, it gets killed. It has a 48% loss. So its sum of returns is 12%. Now let's look at the low volatility portfolio. True to form, in the 4 good years, instead of being up 15% each year, it's up only 5. So after 4 years, you've got a sum of returns of only 20% as opposed to 60%. Now, true to its character again, in the bear market, in year 5, instead of losing 48%, it loses 15%. So it has a sum of returns of 5% compared to the 12% for the high volatility portfolio. Now let's go to the actual dollars again. The high volatility portfolio is in a loss position. At the end of year 5, with a sum of returns of 12%, it's worth about $910,000. So you still have a loss of approximately $90,000. The low volatility portfolio that only went up 5% a year in the good times in the first 4 years is still in a winning position with a gain of $33,000. It's worth $1,033,000 at the end of year 5. So you can see that with the high volatility, one large loss can wipe out years of gains, whereas the low volatility portfolio is much less exposed to that phenomenon. So you can see how risk management, specifically mitigating volatility and avoiding large losses in bear markets, is essential to achieving superior long-term returns. At Outcome, that lies at the foundation of how we invest. We use machine learning-driven, data-based investment models to mitigate volatility, avoid large losses, so that our clients can achieve superior long-term results. Thanks for watching. If you want to learn more about Outcome Metric Asset Management and our investment strategies, please visit our website at outcomewm.com, where you can receive our contact information and sign up for our monthly newsletter.